Hey there YouTube. So in this video I wanted to cover how to complete IRS Form 1042S. So this Form 1042S is titled Foreign Persons U.S. Source Income Subject to Withholding. So when do you need to complete this form? Anytime you as a U.S. payor are making payments to a foreign person, so it's a non-resident individual or a non-resident company, and it's of U.S. source income, you generally need to file this form. And it's also filed whether there's any withholding tax or not. If you have withholding tax, you definitely need to file this because you have to appropriately record how much income was paid to the non-resident and how much tax is being withheld and sent to the IRS. So I've got a sample form in front of us, and then one slide that we're just going to go over really quickly, and then we'll jump back to the form itself. Okay, so the form, like I said, it is required to report U.S. source payments to non-residents, and this applies whether or not any withholding tax is required. So for example, a lot of U.S. source interest payments must be reported to non-residents. However, they're generally not subject to tax or withholding under Chapter 3 because of portfolio interest exemption. So for example, if a non-resident opens a bank account with a U.S. bank and it's a savings account and they earn, let's say $1,000 in interest income on that account. Interest income on U.S. bank accounts is generally portfolio interest. So the bank might be reporting the interest to the non-resident as U.S. source bank interest, but there's no withholding tax. In this example, what we're going to do is we're going to look at U.S. source dividends being paid to a non-resident owner. Okay, now the Form 1042S is way more complicated than 1099s. So the 1099 miscellaneous or the 1099 NEC or the 1099 div. There's way more fields, there's more information reported, and there's just more variables, right? If you actually look at the instructions, all the exemption codes, the income codes, the treaty limitation on benefits codes, all of these pieces, a lot of moving parts. So for this example, I'm just going to focus in on this one fact pattern, and I'll describe all the fields kind of generally, but I'm not going to go over a lot of different scenarios because we'll be here for 3 hours, and I don't think you want to hear me talk that long. So here's the fact pattern we're going to be working with. We have fake XYZ Delaware entity. This is a Delaware corporation that's taxable as a C Corp for federal income tax purposes. And the Delaware corporation is owned 100% by a non-resident shareholder, Australia Company Limited. Okay, so it's an Australian entity, and it owns 100% of the stock in the Delaware corporation. Now, during 2021, the Delaware Corp decided to issue a dividend distribution of $100,000 to the shareholder. Right, so C corporations are allowed to issue dividends to their shareholders, right, out of accumulated earnings. So that's what occurred here. $100,000 was going to go to the Australian shareholder. So before payment was remitted, the Australian shareholder provided a Form WABENE, right? That's a withholding certificate for a foreign entity. And it completes this to verify its foreign status. And it also completed Part 3 within the WABENE to claim treaty benefits. And in the treaty benefits, it asserts that it's entitled to a reduced withholding rate of 15% on U.S. source dividends. Okay, now that's important because the standard Chapter 3 rate for U.S. source dividends paid to non-residents is 30%. But if the non-resident shareholder is based in a treaty country, so this is a tax treaty signed between the U.S. and that foreign country, you might be eligible to get a reduced withholding rate. And so that's the position they've taken. Now, the Delaware Corporation withholds $15,000 in taxes from the 100, and it pays that to the IRS. So effectively, the Australian shareholder gets $85,000, right? So they get $85,000 out of 100 because the IRS wants their piece of the U.S. source dividend income. So they get 15%. All right, so the Form 1042S has a number of different fields on it. We have information on both parties, the amount of income, taxes withheld, the character of the income, and the treaty position taken. Okay, so now let's look at the form itself and all the fields that we're required to that are required to be completed given our fact pattern, right? So there's a lot of fields that are blank here, obviously, because they're not relevant. For our fact pattern, they might be for years, so you really got to focus on what's the relationship between the parties, who's receiving the income, do treaty benefits apply, a lot of different pieces. So we'll just start at the top, work our way down, and then of course at the end of the video, if there's anything I didn't cover, please feel free to leave a question on the video, and I'm happy to answer any I can. So if we start at the top here, the unique form identifier. So this should be entered by you as the one filing this form or the withholding agent. This is just a unique form number. It can be randomized. It's just got to be numerical digits. And what this does is this identifies the 1042-S that you're filing. And that's important because if for some reason you need to amend this, you would use the same unique form identifier and then check the amended box. Okay, so you would indicate that, I messed up something, so I'm redoing it. I'm using the same unique form identifier as the one I messed up. I'm checking the amended box, and then you enter, what series of amendments this is. Now, box 1, income code, you'll have to look at the instructions or the listing. You can either look at the 1042-S instructions themselves, or within the forms here, they have a lot of the codes every other page. So in this case, what we're working with, again, is U.S. source dividend income. So we have dividend income down here, dividends paid by U.S. corporations generally, so code 6. So that's how this works. If there's a section where you have to enter a code, look at the table, figure out what code you need to enter, and then enter the appropriate code. So we have code 6 here for U.S. dividend income, and the gross amount of dividends is $100K, right? So this would be, if this was interest income, you'd have a code for interest income, put in interest, rents, royalties, whatever it might be. In our case, we have $100K worth of gross income from U.S. source dividends. Now, box 3, chapter indicator, either 3 or 4. Chapter 3 is what we're working with now. Chapter 3 covers withholding taxes on U.S. source income paid to non-residents. Chapter 4 covers U.S. FACA. So in certain circumstances, if you're making payments to a non-resident and they're not compliant with FACA, you might have to withhold tax under Chapter 4, and the same principles apply, right? You complete this form, compute the rate that's required, withhold the tax, and then send that off to the IRS. So in this case, we're not dealing with Chapter 4. This company is compliant with it, so we're only withholding tax under Chapter 3. So we have Chapter 3. Now, 3A is the exemption code. So this would be entered, in our case, we're just having 00 because there is no exemption, right? We are not exempt from Chapter 3 withholding under this type of income, so we have to report something. This would be entered, for example, if you had portfolio interest, right? So if you had something like a portfolio interest exemption, so the tax rate would be 0, you would have a portfolio interest exemption if you had interest income paid. That would apply here. But in this case, with our fact pattern, U.S. source dividends paid to Australia, no exemption applies, so our tax rate is 15%. Now the 15% rate, again, that's the reduced treaty rate, so we'll cover, there's another section later on in the form covering treaties, so we'll get to that later. Boxes 5 and 6 don't apply here for U.S. source dividend income. Withholding allowances and net income, only these fields have to be completed for certain types of income. So payments for like personal services or compensation, in those cases you might have to have a withholding allowance applied, and so you might have to fill out those fields then. But again, for our example, we're leaving them blank because it doesn't apply. 7A, federal income tax. This is the amount of tax that we are withholding at source, right? So 15% on the 100 gram, we've got to take 15,000 out. Okay. There's a bunch of other fields here. Again, none of this applies for our fact pattern. Much more complicated scenarios that would cover those. So I'm just going to skip down to line 10, which is a combination of all these types of withholding tax. And the total that we've got here is 15 grand. Now, line 11, tax paid by withholding agent, do not confuse this with the amount that we're withholding. What they mean there is that if we paid $100,000 in dividend income to the Australian entity, but we forgot to withhold the tax, and so now we as the withholding agent have to come out of our own pocket with it, then we would put that amount there, right? So there are amounts paid by the withholding agent that were not withheld. Again, doesn't apply here because we knew we needed to withhold the tax, so we took the $15K out, we only gave him 85, and so we've done everything right. Now, withholding agent's EIN, this is the company's EIN that's making the payment, right? So the company that's making the payment is the first withholding agent. It's possible to have qualified intermediaries or some other entity responsible for that, but in our case, no. We're filling this out on behalf of this entity. We're the withholding agent, so you would use the company's EIN, their Chapter 3 status code. Again, look beneath for those code sections to figure out what kind of withholding agent this is, and the name of the entity, okay? Now, 12E, the withholding agent's GIN, Global Intermediary Identification Number. This is a number, this is, again, have to do with U.S. FATCA, so GINs are, they're ID numbers issued to non-U.S. companies that might have a withholding obligation. So again, this would apply more so in a Chapter 4 kind of withholding context. So again, this is a U.S. entity, so the GIN wouldn't be applicable to them. Country code, where's the entity set up? In this case, it's a U.S. entity. Again, it is possible to have non-U.S. companies making payments of U.S. source income and then have to withhold. So, carefully, assess where your company is established, and then make sure you get all these elements right about country code and foreign tax ID number if it applies. Okay, so address information for our Delaware entity, right? We have their address, city and state, and then the recipient's name. This is the shareholder that's getting the payment, right? So we have Australia Company Limited, their country code, where's the entity set up, street address, city, town, state, province, country, zip code, all of that stuff should go in there. Okay, so that covers this first left-hand column. Now, if we scroll back up, okay, so recipient's U.S. TIN, if any. It's very common not very common, but it is common in some cases for non-U.S. entities to have EINs, right? So if you have this Australian company here, maybe they might have applied for an EIN because they needed to open a U.S. bank account. If that's the case, then you would put the U.S. EIN in there if they had one. In this fact pattern, we don't, right? So it's Australian shareholder. They have a foreign tax ID number, right? So you should enter that there. But they don't have a U.S. EIN, and they don't have a GIN either, okay? Now, 13J, LOB. So LOB is Limitation on Benefits Code. This has to do with the treaty. So limitations on benefits it's an article within most U.S. tax treaties that says if you are going to claim treaty benefits, so in this case we're looking to this company here, if Australia Company Limited is going to claim treaty benefits, it is going to need to enter or support that it meets the limitation on benefits provisions in the treaty. And what that means for the most part is that, look, if you're an Australia company, you've also got to support that you have Australia-based shareholders or Australia-based operations, so you're a true Australian tax company, right? You can't just use intermediary entities to try to claim treaty benefits. So in this case, the appropriate LOB code was 07, which I believe is the base erosion test. I'll scroll down here, show you where all these are. So again, a lot of different codes here. Where is it? It's going to be further down here, I think. Yeah, okay, here we go. Box 13J, LOB categories. So in our case, yeah, so we're 07, which means that we're a company that meets the ownership and base erosion test. And that means exactly what I just kind of said. The shareholders of the company are Australian tax residents, right? So there's a look-through provision in effect that just makes sure that the individuals that set this thing up are actually Australian tax residents, and so they could claim the treaty benefits anyway. Okay, so we've got 07, recipient's foreign tax ID number. The account number would be entered if this was a bank, right? So if this was a bank making a payment to a non-resident account holder, they would enter the account number there. Date of birth, again, this is an entity, so it doesn't apply. And then primary and intermediary withholding agent information. This goes back to if this withholding agent here wasn't the one withholding the payment, we would have more information entered here because we have an intermediary or flow-through entity responsible for that. But again, that's more complicated scenario. We don't have that here. We just have a very simple fact pattern where Delaware Corporation is making a payment to a non-resident shareholder. What do they need to fill out? And then boxes 15 through 17 here, this would all apply if we had the intermediary flow-through entity up here. So those fields don't need to be completed for this fact pattern. Okay, so that covers it for this 1042S example. Now, just to kind of recap what also needs to be done, the 1042S is filed for each type of income for each payor. So what I mean by that is, let's say in addition to the dividend income, you also paid interest to this company. So they received a dividend, but there was also a shareholder loan and there was interest payments going out. You would have a separate 1042 for the interest payments, and then you would have this one for the dividends. Now, all of the numbers are basically consolidated and reported on a 1042, so that's without the S. So 1042 is what is used to report as kind of a transmittal form, and it reports all of the gross income that was paid out and all the tax that was withheld, and that's how the IRS reconciles everything. That's how they know that, okay, this is the total amount of income across all the 1042S's, total amount of tax, and this is what you as the withholding agent are paying in during the year or when you're filing the form. So that covers it. I hope that was helpful. If you have any questions, like I said, please leave me a comment below, and I look forward to seeing you again on the next video. Thank you.